You know, usually when we talk about a medical diagnosis, there's this expectation of like absolute precision. It feels almost like engineering, right?
Right, yeah.
Like you fall off a bike, you break your arm, the x-ray shows that jagged white line on the screen, and the doctor just points and says, you know, there it is.
It's comforting. I mean, it's binary. The bone is broken or it isn't. The problem is visible. It can be categorized, and we can immediately start talking about the cast.
Exactly. But then you step into the world of healthcare economics, and specifically into the corporate earnings of these massive medical conglomerates, and suddenly that x-ray machine feels completely broken.
Oh, completely.
We're looking at a diagnostic landscape that is just incredibly murky, full of moving parts, shadow pricing, regulatory shifts. It's a completely different kind of anatomy.
Which is exactly why surface level numbers in this sector can be so deceptive. I mean, if you just look at the top line of a healthcare conglomerate, you are essentially looking at the skin of the patient.
Yeah.
You have absolutely no idea what the internal organs are actually doing, or, you know, whether the cardiovascular system is about to just fail.
And that brings us to our mission today. Welcome to this special Talk Tickers edition of the Deep Dive. We are taking a magnifying glass to the Cigna Group, shock ticker CI, and we're unpacking their Q2 2026 earnings call.
It's a big one.
It really is. Now, the mission of Talk Tickers is always the same. We want to cut through the corporate jargon, extract the hard data, and give you, the retail investor listening to this, a clear, actionable translation from Wall Street to Main Street.
Right, because we want to know if this stock is a safe harbor, a value trap, or, you know, an absolute growth engine.
Exactly. And we are dealing with some incredibly rich source material today. We've got the official transcript featuring CEO Brian Ivanko and CFO Ann Dennison.
And what makes this particular call so vital, I think, is that the under-the-hood dynamics happening at Cigna right now, they're a perfect microcosm of the entire U.S. healthcare system in 2026.
Yeah, 100%.
We aren't just looking at a company's ledger. We are looking at the collision of artificial intelligence, the exploding and super controversial cost of weight loss drugs.
Oh man, the weight loss drugs.
Right, the GLP-1s, plus massive legislative shifts in the pharmacy benefit model, and they're sunsetting major government-linked healthcare programs.
It's a lot. So we're going to unpack the headline numbers, dive into the story behind those numbers, examine management's guidance for the rest of the year, and then give you a definitive bottom line. Okay, let's unpack this.
Let's do it.
We have to start with the sheer scale of the operation, because the numbers here are, frankly, they're almost difficult to comprehend. For the second quarter of 2026, Cigna's total revenues hit $71.7 billion.
I always like to pause when we hit a number like that, because the human brain just struggles to contextualize it.
Right.
That is for a single quarter.
Over $70 billion in 90 days. I mean, there are entire sovereign nations that do not generate that kind of GDP in a year.
Yeah, it's staggering.
And their adjusted earnings per share, or EPS, came in at 7.78. Now, to understand how they're generating that massive pile of cash, we need to split Cigna into its two main engines. You have Evernorth, which is their health services and pharmacy division.
Right.
And you have Cigna Healthcare, which is the traditional insurance side of the house. Now, Evernorth pulled in $61.5 billion, which is up 6% year over year. Cigna Healthcare pulled in $11.8 billion, which is up 10% year over year.
And that revenue split, I mean, that tells you everything you need to know about what Cigna actually is in 2026.
How so?
Well, most people hear the name Cigna and they immediately think of their health insurance card in their wallet, right?
Right. Going to the doctor, showing the card.
Exactly. They think of the traditional Cigna Healthcare division, but looking at the actual data, the traditional insurance business is totally dwarfed by Evernorth.
Yeah, $61.5 billion versus $11.8.
Right. Evernorth is the massive revenue driver. It brings in the lion's share of that $71.7 billion.
And building on that, I mean, this is a crucial distinction for anyone valuing the stock. You're not just buying a traditional insurance company. You are primarily buying a massive pharmacy benefit and health services behemoth that just happens to have a very profitable insurance arm bolted onto it.
That's a great way to look at it.
But let's look at that insurance arm for a second, because we have to talk about the metric that everyone in the healthcare space watches like an absolute hawk, the medical care ratio, or MCR.
Oh, yeah.
For this quarter, it landed at 84.5%.
Which is really the heartbeat of any managed care organization.
Right. So let's translate this medical care ratio for you, because it sounds like this dense actuarial jargon, but it's actually a super simple concept. Think of the MCR like a restaurant's food cost percentage.
Okay, I like that.
So if you run a high-end steakhouse and you charge a customer $100 for a steak dinner, and the raw steak, the potatoes, the butter, all that costs you $30 to buy from your supplier.
Your food cost is 30%.
Exactly. It tells you exactly how much of your revenue is being eaten up by the raw materials. Now, in the insurance world, the raw material is patient care. So MCR is the percentage of premium dollars Cigna actually spends on paying claims.
Right. And that includes, paying the doctors, the hospital networks, covering the MRIs, the surgeries, the emergency room visits.
Yeah, all the actual care. So at 84.5%, it means for every single dollar you pay Cigna in premiums, they're spending 84.5 cents on actual medical care.
Which leaves them with 15.5 cents to cover their administrative costs, their marketing, tech investments, and obviously their profit margin.
Exactly. It is the ultimate metric of an insurer's efficiency, their underwriting discipline, and basically their pricing accuracy.
Which makes that 84.5% number the absolute star of the show for the Wall Street analysts on the call.
Because it came in better than expected.
Oh yeah, it came in slightly better. And in this industry, better means lower than the street expected. In the insurance business, a lower MCR is the ultimate goal because they get to retain a larger slice of the premium dollar.
And I'd imagine keeping that MCR down right now is incredibly difficult, just given the inflationary environment we're in. I mean, everything costs more.
It is exceptionally difficult. And that's what makes this quarter's print so fascinating, really. Broadly speaking, across the entire healthcare industry, medical cost trends are remaining elevated.
Right.
CFO Ann Dennison was actually very transparent about this on the call. She noted they are still seeing, quote, high single-digit type cost trends.
Price single digits, wow.
Yeah. Hospital contract prices have been marching upward, labor costs for nurses and technicians are way up, and the overall demand for complex care is growing as the population ages.
Right, the baby boomers.
Exactly. But against that highly elevated inflationary backdrop, Cigna's medical costs were slightly favorable to their own models.
So I have to ask, how did they manage that? If hospital prices are up and labor is up, what actually drove the MCR down?
The specific call-out from management was a dip in outpatient surgical spend.
Outpatient surgeries. So people getting like a knee arthroscopy or a cataract removed and going home the same day.
Precisely. While overall costs across the system remained high, they saw a pocket of breathing room on the outpatient side. Essentially, just fewer people were utilizing those day surgeries than the actuarial models had predicted for the quarter.
Which offset the inflation they're absorbing everywhere else in the system.
Exactly.
But here is what I find really telling about the leadership team. CEO Brian Ivanko, he did not take a victory lap on this.
No, he didn't.
During the Q&A portion of the call, an analyst from UBS asked if this surgical dip was enough to fundamentally move the needle on their overall cost trends going forward. And Ivanko was incredibly disciplined.
He was.
He said, look, we are still seeing persistently elevated cost trend levels. There's no significant deceleration in inflation. Fortunately, there's no acceleration either. They're still actively modeling for a tough, elevated cost environment all the way through 2026 and into 2027.
And honestly, that is the hallmark of a conservative, mature management team. It is exactly what you want to hear as a retail investor.
Yeah, you don't want them getting ahead of themselves.
Right, because the worst thing a CEO can do is take a temporary one-quarter tailwind like a random dip in outpatient knee surgeries and project it out as a permanent structural advantage.
Right, and then miss earnings completely the next quarter.
Exactly. They get a win on MCR for the quarter, but they're keeping their guard up. They're pricing their future premiums under the assumption that those surgeries are going to bounce right back.
So we have the top line numbers, over $70 billion in revenue, an 84.5% MCR that beats expectations, and conservative management. But to really understand this company, we have to look at what is fueling the Evernorth side of the business.
Because it's huge.
Right. A behemoth this size has a lot of shifting tectonic plates beneath the surface. And that brings us to the story behind the numbers, where we really need to unpack biosimilars, artificial intelligence, and the massive structural changes happening in pharmacy benefits.
This is where we move from the X-ray to the MRI.
I like that.
Yeah, the nuances here are what actually dictate long-term shareholder value.
So let's start with the biggest boom in the quarter. Inside that massive Evernorth division, there's a segment called Specialty and Care Services. In Q2, their pre-tax adjusted earnings absolutely skyrocketed.
Skyrocketed is the right word.
We are talking about a 22% increase year over year, hitting $1.1 billion. And reading through the transcript, this was fueled by a faster than expected adoption of biosimilars and specialty generics. They noted that market penetration for these newer products surpassed 80%, incredibly early in the year.
And CFO Ann Dennison specifically highlighted generic Revlimid, which for context is a major cancer treatment, as a prime example of this driving affordability.
Okay, I need to push back here because the underlying math of this just feels counterintuitive to me.
Okay, how so?
Wait, if we're talking about biosimilars and specialty generics, we're essentially talking about the cheaper, quote-unquote, store brand alternatives to high-priced brand name designer drugs, right?
In the simplest terms, yes. Though, biosimilars are vastly more complex to manufacture than your standard generic ibuprofen pill.
Right, they're grown in cells and all that. But the ultimate goal of a biosimilar is to lower the price.
Yes, absolutely.
So if the drug is suddenly vastly cheaper, doesn't that mean the total amount of money changing hands in the system is lower? How in the world is a massive shift toward cheaper drugs driving a 22% profit increase for Cigna's specialty division?
It seems like a paradox, right?
Yeah. If the price drops, shouldn't Cigna be making less money?
It is a brilliant question, and it really gets to the absolute core of how modern pharmacy economics actually function.
Okay, explain this to me.
To understand this, you have to completely separate top-line revenue from bottom-line margin. You are absolutely correct that the absolute cost of the drug drops when a biosimilar enters the market.
Okay.
Ann Dennison confirmed this on the call. She stated that because the drug costs are lower, you will not see a proportional increase in the top-line revenue. The gross dollars moving through the pharmacy system literally shrink.
So a biologic drug that used to cost, say, $10,000 a month suddenly has a biosimilar competitor that costs $2,000 a month.
Exactly. Now, that massive price drop clearly benefits the patient, who might have a percentage-based coinsurance and therefore sees lower out-of-pocket costs at the counter.
Right.
And it obviously benefits the client, which is usually the corporate employer who's actually footing the bill for the health plan.
Right.
But here is the mechanism of how Cigna makes more money.
I'm listening.
For Cigna's Evernorth division, they don't manufacture the drug.
Right, they're the middleman.
They make their money on the procurement, the management, and the dispensing of these complex therapies. And they do this particularly through their specialized in-house pharmacy, which is called Accredo.
And Accredo isn't a corner drugstore. This is an operation built for clinically intensive medications.
Yeah, Accredo handles the hardest stuff in medicine. We are talking about specialty therapies for rare diseases, oncology, complex autoimmune disorders. These are not just, pills in a bottle.
Right.
These therapies often require intense cold chain shipping, precise clinical care teams, constant patient monitoring, and specialized nursing support just to teach the patient how to administer an injection safely.
So Cigna's infrastructure is doing a lot of heavy lifting.
And that infrastructure is indispensable. So when a hugely expensive brand name biologic drug loses its patent protection and multiple biosimilars rush into the market, a price war begins among the manufacturers.
That's right.
And Cigna steps into that arena wielding massive negotiating power. Because Cigna controls the Accredo distribution channel and the insurance formulary, they can essentially pit the manufacturers against each other.
Ah, I see.
They negotiate highly favorable economics, securing a larger administrative fee or a wider spread for their dispensing services. So they're improving their operating efficiency and their margin, even as the top-line cost of the drug falls.
That makes perfect sense. I use a different analogy here to help visualize it.
Go for it.
It's like a real estate broker operating in a wealthy neighborhood, right? If the broker is selling a $10 million mansion, they might only be able to negotiate a 2% commission because the seller is stubborn and holds all the cards.
Right.
But if the market shifts and they are suddenly selling 20 smaller houses for $2 million each, they might be able to demand a 6% commission on every single transaction because there's more competition among the sellers.
Yes.
The total dollar value of a single house went down, but the broker's slice of the pie got much thicker because they have more leverage in the volume.
That is a perfect way to visualize it. Cigna is taking a thicker slice of a much smaller pie. And because the pie is getting smaller, the actual client, the employer paying for the health plan, is still saving a massive amount of money.
It's crazy.
It is a rare win-win-win in healthcare economics. The employer saves money, the patient saves money, and Cigna structurally increases its profit margin. And the speed at which this adoption happened in Q2 was staggering. They had built strong biosimilar adoption into their full-year guidance, but hitting that 80% penetration mark so early in the year, that acted as a massive catalyst for that $1.1 billion profit print.
But, the boom in the specialty segment came with a noticeable squeeze somewhere else.
It did.
While specialty shot up 22%, the pharmacy benefit services segment, or PBS, actually dropped to $609 million for the quarter.
Right. And that drop is the result of a massive structural transition they are currently executing.
Okay, what's the mechanism behind the drop? Because if specialty drugs are booming, why is the traditional pharmacy benefit side taking a hit?
Well, it's a combination of two things. First, the PBS segment drop reflects the loss of some large client contracts that just naturally transitioned over to their specialty side.
Okay, so just moving money from one pocket to another.
A bit of that, yeah. But much more importantly, it reflects heavy, front-loaded investments into a brand new pricing model they're rolling out called Signature.
The new 2028 rebate-free model. We really have to dive deep into this because the word rebate in the pharmacy benefit world is arguably the most controversial term in healthcare right now.
Oh, without a doubt. It carries an incredible amount of baggage. To understand what Cigna is doing with Signature, you have to understand the legacy model they're actively trying to destroy.
Break it down for us.
For decades, the pharmacy benefit manager, or PBM, has operated as a middleman between drug manufacturers, pharmacies, and insurance companies, and their profit model has been heavily reliant on secret rebates.
How does that actually work in practice? Like mechanically?
Okay, let's say a pharmaceutical company invents a new cholesterol drug. They set an artificially high list price, let's say $500 a month.
Okay.
But the drug manufacturer wants the PBM to place their new drug on the preferred tier of the insurance formulary.
So doctors will actually prescribe it, right?
Exactly. So behind closed doors, the manufacturer negotiates a secret rebate. They say to the PBM, if you favor our drug, we will secretly pick back $200 to you for every single prescription filled.
So the drug looks like it costs $500 to the outside world, but the actual net cost is $300, and the PBM is just pocketing that $200 spread.
Exactly. Now, to be fair, the PBM does share some or even most of that rebate with the corporate employer who sponsors the health plan.
Right.
But here is the insidious part. The patient standing at the pharmacy counter often ends up paying a percentage-based coinsurance or deductible based on that artificially inflated $500 list price.
Oh, wow.
Right. They're completely unaware of the $200 kickback happening in the background. It is an incredibly opaque, convoluted system that essentially incentivizes drug companies to continuously raise list prices just so they have more room to offer bigger rebates to the middlemen.
Which is why it has drawn the absolute ire of lawmakers, patient advocacy groups, and employers alike.
Oh, completely.
Yeah.
And CEO Brian Ivanko didn't mince words on the call. He explicitly said, quote, everyone acknowledges that the status quo is unsustainable.
Wow.
When the CEO of one of the biggest healthcare conglomerates in the world openly admits the fundamental pricing model of his industry is broken, a seismic shift is not just coming, it's already here.
And that shift is this new Signature model. Cigna is moving to a fully transparent, fee-based arrangement.
Yes.
They're completely ditching the hidden rebates. They are building it on a cost plus a dynamic dispensing fee framework.
Cost plus, it's an elegant solution to a very chaotic problem.
So under this new model, they just take the actual unvarnished cost of the drug from the manufacturer and they add a flat fee on top of it for doing the logistical work.
Yes, and that fee is dynamic, meaning it scales based on the clinical complexity of handling and dispensing that specific drug.
Yeah.
It completely demystifies the transaction. The employer sees exactly what the drug costs and exactly what Cigna is charging to manage it. And Ivanko mentioned this aligns perfectly with the Consolidated Appropriations Act provisions coming in mid-2028.
Okay, let's pause on that act because legislation drives so much of healthcare economics. What does the Consolidated Appropriations Act actually do?
It's essentially a massive package of federal government regulations that, among other things, places stringent fiduciary duties on corporate employers who sponsor health plans.
Okay.
It legally forces these companies to audit their healthcare spending and ensure they are getting fair value, which means they can no longer turn a blind eye to opaque PBM rebates. They are legally required to demand transparency.
So the government is really forcing the market's hand here, but Cigna is trying to get ahead of the curve. They're rolling this Signature model out to their own fully insured plans in 2027 and scaling it to the broader self-funded employer market in 2028.
Exactly. And building that entirely new pricing architecture from the ground up requires massive investment in technology, contracting, and sales education.
Right, retraining the whole sales force.
That is what is dragging down the PBS earnings right now. It costs money to disrupt yourself.
But the leading indicators suggest the gamble is paying off, right?
Big time.
Ivanko noted their 2027 selling season, which is the period right now where they lock in massive corporate clients for the upcoming year, is one of the strongest in recent history. They're retaining over 97% of their existing business, and their total new business already secured for 2027 is above the prior two selling seasons combined.
Beating the last 2 years combined is a staggering metric in an industry that usually grows incrementally.
Yeah.
It proves that corporate employers are absolutely desperate for this transparency. Because of those new fiduciary duties, the old rebate game was making their legal compliance basically impossible.
It really shows that Cigna's pivot, while it might cause a short-term ding to the PBS segment's quarterly earnings, is actually a brilliant offensive move securing massive long-term market share.
Absolutely.
They are cannibalizing their own old model before a competitor or the government does it for them.
Exactly. And speaking of technological investment, we really need to transition to how they are actually managing the clinical operations, because this earnings call leaned heavily into artificial intelligence.
Yes, it did.
And I don't mean AI as a vague corporate buzzword here. Cigna is deploying it in a massive, quantifiable way, specifically through a program they're calling Pharmacy Forward.
The metrics they cited around this are phenomenal. They are using AI to cut a patient's time to therapy in half, and they're reducing clinician documentation time by up to 50%.
Right.
Let's break down what time to therapy actually means in the real world, because it is so much more than an administrative metric.
It is arguably the most critical metric in a patient's journey. Think about a patient who just received a devastating, highly complex diagnosis, say a severe autoimmune disorder or a rare form of cancer.
Okay.
The specialist prescribes a highly targeted specialty medication. In the old analog system, that prescription kicks off an absolute nightmare of administrative friction.
We've all been there, the endless phone trees, the faxes.
Oh, the faxes. It requires prior authorizations to ensure the insurance covers it, complex verifications, checking if the drug needs cold chain shipping logistics,
Right.
and then scheduling the clinical support to actually teach the patient how to inject or infuse it safely. That entire bureaucratic dance could take weeks.
Weeks where the patient is just sitting at home, sick, anxious, and waiting for the red tape to clear so they can start fighting their disease.
Which is horrific for the patient and frankly terrible for their eventual outcomes.
Yeah.
With Pharmacy Forward, Cigna is using AI to instantly ingest all of the patient's medical data, cross-reference it against the vast library of clinical guidelines, and instantly check it against the specific rules of their insurance coverage.
Wow, so it's instantaneous.
Right. It streamlines and automates that entire authorization and onboarding process. Cutting that time in half isn't just an efficiency win for Cigna. It is a massive clinical victory for the patient.
And the other side of that coin is taking 50% of the documentation burden off the clinicians. Because if you talk to any doctor or nurse today, their biggest complaint isn't the medicine, it's the charting.
Exactly.
Right.
Ivanko was very clear on the call. This initiative isn't about replacing clinicians with algorithms. It is about freeing up human capacity so doctors and nurses can actually practice at the top of their license.
Right.
It means they get to look the patient in the eye, ask nuanced questions, and deliver empathetic care rather than staring at a computer monitor filling out repetitive forms.
But the AI isn't just functioning as an administrative assistant. They're also deploying it as a predictive tool for care coordination.
Yes.
The transcript noted they're using advanced predictive models to comb through data and identify customers who have emerging complex or chronic health needs much earlier. Things like early-stage cancer, creeping heart disease, or high-risk pregnancies. And the financial and clinical impact of this foresight is just huge.
The numbers they released are definitive. By using AI to flag these patients early and proactively reaching out with personalized clinical support, they're saving an average of $2,000 per engaged patient per year.
That's a lot of money.
It is. But even more impressively, they are cutting avoidable inpatient hospital stays by 42% among those specific customers.
A 42% reduction in avoidable hospital stays. I mean, if you want to know how you tame healthcare inflation, that is the holy grail.
Absolutely.
Because the most expensive place on earth to be is a hospital bed.
A single admission can run into the tens or hundreds of thousands of dollars.
Right. So if an AI model can detect a subtle change in a patient's refill history or lab work, predict a complication, and coordinate a simple outpatient intervention, like a telehealth visit or a medication adjustment, before it spirals into a full-blown emergency, everybody wins.
Everyone wins.
The patient stays safe and comfortable in their own home, and Cigna avoids paying a catastrophic claim.
And if you trace that thread all the way back to the beginning of our conversation, it perfectly reinforces why their medical care ratio came in so favorably this quarter.
Oh, right. The MCR.
When you connect deep data insights with proactive action at this kind of scale, you fundamentally alter the cost trajectory of your entire insured population.
Which brings us to the final and undoubtedly the most explosive dynamic we need to unpack, the GLP-1 drama.
Oh boy. It is the single biggest, most contentious topic in global healthcare right now.
For anyone who has been living off the grid, GLP-1s are the class of drugs that include medications like Ozempic, Wegovy, and Zepbound. They were originally developed to manage diabetes, but they have proven to be incredibly effective, driving an absolute gold rush for weight loss.
They are essentially reshaping the pharmaceutical landscape, but they come with an astronomical price tag, especially when you are treating millions of people for obesity on a chronic, ongoing basis.
And the earnings transcript had an absolute bombshell hidden deep in the Q&A session. An analyst from Tanner Fitzgerald pointed out a recent policy change, and management confirmed it. On July 1st, Cigna actually stopped covering GLP-1 weight loss drugs like Wegovy and Zepbound for its own employees.
Just let the magnitude of that sink in.
A $70 billion a quarter healthcare behemoth, a company that literally manages drug benefits for a living, looked at their own internal balance sheet and said, "We cannot afford to pay for this."
It is a stunning admission of the underlying economics, and CEO Brian Ivanko didn't shy away from it. He tackled it head on.
What did he say?
He explained that, just like any other large corporate employer in the United States, Cigna is faced with constant, agonizing trade-off decisions regarding the comprehensiveness of their employee benefit programs versus the sheer cost of sustaining them.
Right.
He called it a difficult decision, but he stated bluntly that the net costs of these GLP-1 drugs are severely straining overall affordability.
Now, to be clear, they are still covering GLP-1s for their employees who have a clinical diagnosis of diabetes.
Yes, that is a crucial medical distinction.
Right. But for pure weight management, they pulled the plug. They're offering a discount program if employees want to pay out of pocket, but the corporate entity is no longer subsidizing the massive monthly cost.
And Ivanko essentially used the earnings call to put the pharmaceutical manufacturers on notice.
Oh, definitely.
He said, and I quote, "Should drug manufacturers decide to meaningfully discount the net prices they offer, we may revisit this in the future."
Wow.
He is publicly using Cigna's own employee health plan as a cudgel to demand lower prices from Big Pharma.
It is the ultimate canary in the coal mine. If Cigna, with all of its negotiating leverage, its deep pockets, its in-house pharmacy infrastructure, if they can't make the math work to cover these drugs for their own staff, how in the world is a mid-sized manufacturing company in Ohio or a school district in Texas supposed to afford it for their employees?
The brutal reality is they can't. And that's exactly what Cigna is observing across their broader client base. CFO Ann Dennison noted earlier in the call that they observe a moderating growth rate for GLP-1s in Q2.
Moderating, meaning slowing down.
Right. And the reason for that moderation is that overall coverage levels across their employer clients have slightly declined.
Employers are literally dropping the coverage.
Yes. Ivanko noted that in their traditional Cigna Healthcare portfolio, only 15 to 20% of their smaller employer book is even covering GLP-1s for weight management anymore.
Wow, only 15 to 20%.
The premium increases required to fund that coverage are just too destructive to the business.
This is a massive headwind for the dominant narrative on Wall Street right now. Because the prevailing story is that these weight loss drugs are going to experience infinite hockey stick growth forever, and that the pharma companies making them are just unstoppable.
Right.
But if the insurance ecosystem, led by the employers who actually fund it, simply refuses to pay the current prices, that growth story, it's a very hard brick wall.
Because the demand from patients is infinite, but the capital available to fund that demand is finite.
Exactly.
However, Cigna as a corporation seems very well insulated from this specific shock. I mean, the slight drop in their PBS earnings due to that lower GLP-1 volume was completely overwhelmed by the massive $1.1 billion gains they made in their specialty and biosimilar lines.
They are highly diversified, and they offer advisory programs like one they call Encircle to help the employers who do want to cover the drugs manage the ensuing financial chaos, offering financing solutions ranging from full coverage models to sponsored voluntary bases. But Ivanko bluntly predicted this specific class of drugs is going to continue to be an area of intense debate, friction, and tension for employers going forward.
So we have biosimilars booming in padding margins, the legacy rebate model being intentionally dismantled and replaced with the transparent signature model.
Yeah.
AI actively driving down avoidable hospital admissions, and the GLP-1 weight loss craze facing a serious reality check on basic affordability.
Which leads us perfectly into the next major phase of our analysis. Management guidance. We know what happened in Q2, but where is this massive ship steering for the rest of 2026? Here's where it gets really interesting.
Management is steering with incredible confidence, and they are backing it up with hard numbers. They raised their full year 2026 adjusted EPS guidance to at least 30.45.
At least they're putting a firm floor under their earnings expectations.
Exactly. And for the Cigna Healthcare division specifically, they raised the full year pre-tax profit outlook to at least $4.55 billion.
Now, this is where it gets incredibly important for you, the retail investor. When a company of this scale is generating this much cash, they are projecting a staggering $9 billion in operating cash flow for the year. The most critical question becomes, what do they actually do with it?
Capital deployment.
Right. Let's look at their capital deployment strategy. In Q2, they repurchased 900,000 shares of their own stock for $250 million.
And we should translate the mechanics of share repurchases because it's a vital tool for shareholder value.
I'll use an analogy here. Imagine a company is a vast neighborhood with a fixed number of houses, let's say 100 houses.
Okay.
If you own one house, you own 1% of the neighborhood. Now imagine the neighborhood association starts generating massive profits, and they decide to use that cash to buy up 10 of the houses from people who want to move away, and they completely bulldoze them and turn them into parks.
Right, they take them off the market.
Exactly. There are now only 90 houses left in the neighborhood. Your one house just became a larger, more valuable percentage of the total available real estate. The equity is concentrated in a smaller footprint. By eating its own stock, Cigna is reducing the outstanding share count, which mathematically concentrates your earnings per share.
It is a massive vote of confidence from management. They're looking at the market, looking at their internal projections, and concluding that their own stock is fundamentally undervalued.
Yeah.
So they're returning $250 million of value directly to shareholders, all while maintaining a highly disciplined balance sheet. They reported a debt-to-capitalization ratio of 42.8% at the end of Q2, and they explicitly intend to pay down enough debt to get that closer to their target of 40% by year-end.
So they're buying back stock, they're aggressively paying down debt, and they're raising earnings guidance. It's a trifecta of financial health.
It really is.
But they aren't just hoarding cash. They're also making some very ruthless, calculated decisions about what parts of the business to keep and what parts to throw overboard. And this brings us to their portfolio shaping. Cigna is officially sunsetting its ACA, which most people know as Obamacare individual exchange business, by the end of 2026.
This is a highly calculated and I'd say very necessary strategic move. To understand why, we have to contrast the economics of the Affordable Care Act individual exchanges with the traditional employer-sponsored market.
Right. And Scott Fidel from Goldman Sachs actually asked about this specifically during the Q&A. He wanted to know how exiting this business would free up capital and resources. Because, it seems counterintuitive to just walk away from a growing pool of insured lives.
But not all insured lives carry the same economic value.
Explain that.
The ACA individual exchanges are a notoriously volatile market. Unlike a corporate employer plan, where you have a stable, predictable pool of thousands of employees year over year, the individual exchanges suffer from immense churn.
Meaning, people come and go.
Exactly. People buy a plan, get the medical care they urgently need, and then drop the coverage. Or they switch plans every single year, chasing the absolute lowest premium.
Right.
Furthermore, the economics are heavily reliant on government subsidies, which introduces a layer of extreme legislative risk.
It's a high-friction, low-predictability environment.
Exactly. And Ivanko's answer to the Goldman analyst was very telling about his leadership philosophy. He said Cigna doesn't feel any compelling need to be all things to all people.
I love that quote.
Yeah, they want to play strictly in markets where they have a differential right to win. And for Cigna, that distinct advantage lies in the U.S. employer market, specifically what they call the select segment, which are employers with under 500 employees.
So the ACA exchanges, despite adding top-line revenue, were essentially a lower margin distraction for the enterprise.
Precisely. And Dennison noted that the margins in that ACA business were technically positive, but they were consistently below Cigna's target return levels. By exiting, they will experience a little bit of friction, what they call stranded overhead in the short term.
Stranded overhead being the fixed costs like IT systems, administrative buildings, or regulatory compliance teams that were supporting the ACA business, and just take a little while to wind down or reallocate.
Right. But taking that short-term hit frees up massive amounts of capital and executive bandwidth to focus fiercely on their core, highly profitable segments.
And where are they redeploying that newfound focus and capital? They are funneling it into high-growth areas, specifically highlighting their investment in Shield's health solutions.
Oh, this is a crucial, often overlooked piece of the Evernorth puzzle. An analyst from Guggenheim asked about the momentum here. To truly understand the value of Shields, you have to understand the staggering scale of the specialty pharmacy market.
Yeah, give us the numbers.
Ivanko noted on the call that this specific sector is approaching a $500 billion total addressable market, and it's growing at a high single-digit rate every year.
$500 billion. That is an ocean of capital.
$500 billion. Now, about 60% of that market is what they call direct-to-patient dispensing. This is where a complex drug is shipped directly to the patient's home, and this is where Cigna already dominates with their massive Accredo pharmacy infrastructure.
Right, we talked about Accredo earlier.
But the other 40% of that market is comprised of provider-administered drugs. These are the incredibly complex, highly volatile therapies that must be administered intravenously inside a hospital setting or a specialized clinic.
And traditionally, Cigna didn't have a massive footprint inside the actual four walls of those hospitals.
Right, because building out specialized pharmacies inside hundreds of independent hospitals from scratch would take decades and billions of dollars.
Yeah.
But Shields Health Solutions completely circumvents that problem. Shields is a company that manages the in-house specialty pharmacies for over 80 major health systems, representing more than 1,000 hospitals across all 50 states.
Wait, so instead of trying to build their own pharmacies, Cigna simply bought the company that manages the pharmacies the hospitals already own?
Yep.
That is a brilliant backdoor play.
Precisely. As hospitals across the country face their own severe margin compression from labor costs and inflation, they are desperately looking to optimize their in-house pharmacies to generate revenue.
Okay.
So Shields comes in, integrates with their electronic medical records, manages the insane complexity of procuring and billing for these specialty drugs, and captures a massive amount of value. It gives Cigna immediate entrenched access into that remaining 40% of the $500 billion market.
Okay, there is one more highly technical thing that came up in the Q&A that I want to touch on before we get to the bottom line, because it perfectly highlights just how chaotic the regulatory environment is for these companies. Charles Rhee from TD Cowen asked about Cigna's exposure to something called the IDR.
The Independent Dispute Resolution Mechanism.
Let's unpack the history of this because it actually affects almost every consumer.
Right.
This mechanism came out of the recent No Surprises Act legislation, which was meant to protect patients from surprise medical bills.
Right.
We all know the horror stories. You go to an in-network hospital for surgery, but you get treated by an out-of-network anesthesiologist, and 3 months later you get hit with a catastrophic, unexpected bill.
The law itself was incredibly well-intentioned. It essentially takes the patient out of the middle of the billing fight. The patient only pays their standard in-network cost sharing, and the insurance company and the out-of-network doctor have to figure out the rest.
Yeah.
But the mechanism designed to resolve that dispute, the IDR process, which uses third-party arbitrators, has basically devolved into an absolute chaotic battleground.
Ivanko was visibly frustrated by this topic on the call. He stated clearly that Cigna supports the core intent of consumer protection, but they are seeing, quote, clear abuses of the IDR vehicle by certain medical providers.
True.
He cited unsustainable volume levels of disputes, heavily concentrated among a small number of private equity-backed provider groups who are using the arbitration process to force outsized inflationary settlements from insurers.
He actually cited independent research showing that this broken arbitration process added $15 billion in healthcare costs across the entire industry in 2025 alone.
Wow.
$15 billion of what he termed wasteful or abusive spending injected directly into the system.
But, and here's the absolute key takeaway for the investor listening to this. Ivanko confirmed that for Cigna specifically, the financial impact of this IDR chaos has been entirely manageable within their planning and pricing assumptions.
That's the crazy part.
Right. They saw the legislative chaos coming, they modeled for it, they priced their premiums to account for the losses, and it hasn't derailed their earnings one bit.
Which just highlights how incredibly resilient this management team is, whether it's macroeconomic inflation, unexpected GLP-1 utilization spikes, or a completely broken federal arbitration process. They find a way to insulate the balance sheet and deliver the promised earnings.
Which brings us to the most important part of our analysis, the bottom line. So what does this all mean for you, the retail investor? We've gone incredibly deep into the weeds today.
We have.
We've unpacked the nuances of the medical care ratio, the predictive power of their AI investments, the margin expansion of biosimilars, and their strategic exit from the ACA exchanges. So filtering all of this data, what's the verdict? Are we looking at a bullish scenario or a bearish one?
Based on the totality of this earnings transcript, the strategic moves they are making, and the immense cash flow generation, I have to take a firm, unequivocal, bullish stance.
Walk us through the final thesis.
Cigna is proving to be a highly defensive, incredibly disciplined, cash-generating machine operating in an exceptionally hostile healthcare environment.
Right.
The macro headwinds they are facing are very real. Elevated medical costs, intense regulatory uncertainty, and the explosion of expensive GLP-1 therapies that are wrecking employer budgets. But Cigna is expertly offsetting every single one of these pressures.
Primarily by leaning heavily into that $500 billion specialty pharmacy market.
Exactly. They are dominating the specialty pharmacy space with Accredo and Shields, moving significantly faster than expected to capitalize on high-margin biosimilars. They are using artificial intelligence not as a marketing gimmick, but to fundamentally alter the cost of care.
Yeah, saving $2,000 per engaged patient.
Right, and keeping people out of the most expensive place on earth, the hospital.
And as we've seen throughout the call, they are absolutely ruthless about their margins and their capital allocation.
Ruthless in the best way possible for someone holding the stock. If the ACA exchange business isn't hitting their target return on capital, they simply cut it.
Gone.
If the legacy rebate model and pharmacy benefits is structurally broken, they are willing to disrupt their own short-term earnings to build the transparent signature model of the future and capture massive market share.
Yeah.
And if they can't justify the exorbitant cost of GLP-1s for their own employees, they have the operational discipline to say no and leverage that decision against the pharma companies.
So the actionable takeaway here is crystal clear. For an investor currently holding or considering initiating a position in the Cigna Group, ticker CI, the data points all point in one direction. The raise EPS guidance to at least 30.45, the aggressive $250 million share buyback that concentrates your equity, the projected $9 billion in operating cash flow, and this ruthless portfolio shaping.
It's all positive.
All of it signals a management team that prioritizes profitable, sustainable growth over sheer, unmanageable size. It is a very strong hold or accumulate signal for the long-term portfolio.
They are essentially immune to the daily noise of the market and focused entirely on execution and margin expansion.
Which brings us to the end of this incredibly dense, fascinating journey. We want to thank you for joining us on this deep dive into Cigna's Q2 2026 earnings. We covered a massive amount of ground today, but hopefully you walk away with a fundamentally deeper, more nuanced understanding of how the healthcare economy is actually functioning right now beneath the surface.
It's an incredibly complex machine fraught with contradictions, but when you break it down layer by layer, the data tells a very clear, compelling story about capital efficiency.
To wrap up, I want to bring it back to that X-ray metaphor we started with.
Yes.
The X-ray of Cigna's financial statement shows a very healthy, heavily muscled machine. The bones are strong, but the environment it's operating in, especially around pharmaceutical pricing, is highly volatile and constantly shifting. Which leads us to a final provocative thought for you to mull over as you research this sector further.
Something that wasn't explicitly debated on the earnings call by the analysts, but is basically the glaring elephant in the room based on the data we just unpacked regarding those weight loss drugs.
Exactly. I want you to think about this. If a $70 billion a quarter healthcare behemoth like Cigna, a company that possesses the ultimate negotiating power and the most sophisticated actuarial models on Earth, has run the math and decided it can no longer afford to pay for GLP-1 weight loss drugs for its own employees, what does that signal for the long-term stock valuations of the pharmaceutical giants manufacturing those drugs?
It's a huge question.
Because right now, those pharma companies are banking their entire future valuations on the assumption of infinite uninterrupted insurance coverage.
It is the ultimate paradox.
Yeah.
If the insurer themselves cannot afford it, who is ultimately going to pay for it?
Exactly. Let that one sink in. Thanks for listening.